Good morning and welcome to the June 10th edition of the Gold, Goats, and Guns Market Report. My name is Tom Luongo and we've got a lot to talk about. Don't have a lot of housekeeping this morning. I want to get right to it. A little distracted getting my thoughts together this morning as to what I was going to talk to you all about, but I remembered a chart that I put together yesterday, actually in preparation for the newsletter, which I don't think is going to make it into the newsletter, so I'm going to give it to you today and explain to you why I think the crisis is the next phase of the crisis is right around the corner. So let's start with what is on tap for today. The Fed's going to have their 2-day open market meeting and going on, and Jerome Powell is going to speak this afternoon to decide whether or not Rabobank over at there's an article on Zero Hedge this morning. Rabobank has a great rundown of the Fed's choices, either the Austrian model or the MMT model. As of right now, Jerome Powell has tried to straddle the two by just keeping interest rates at zero because he doesn't want to raise rates, even though he probably has to, and he doesn't want to go to MMT because he probably has to. The reality is that he's trapped between a rock and a hard place because the Fed is not the solution to this problem. And everybody who keeps looking to the Fed to solve this problem doesn't get it. The central banks don't have the tools to solve this problem. That's what's being revealed, right? So that's where the fallacy is of looking to today's meeting, but everybody's going to look to today's meeting and then make a decision thereof. We're going to go through the charts today. I'm going to paint you a picture of why I think we're in a classic false move on the U.S. dollar and why what Powell says today will affect the short-term iteration of this, the short-term movements on this. I think that's where we are today. I could be wrong, but this is my best guess as to what's happening. You want to look at what's happening in the repo markets. I had this Twitter discussion with a regular interactor on Twitter, and I don't know that he's a patron or not. And if he is, well, speak up. But we've been just chatting back and forth, and he's been pinging. He's a technical trader, and he's been pinging back and forth about the fact that the Fed has been in the repo markets pretty substantially for the last 6 or 7 days. 104 billion here, 110 billion here. After a while, you're starting to talk about real money, right? And I just pointed out to him that what's important is not the amount of repo that's going into the system every day. There's a lot of term repos, a lot of overnight repos. What matters is the net amount that the Fed is carrying on their balance sheet. If that's rising, that's an issue. And if it's just rollover of, older term repos that were put in place back in December and January and February and March and just rolling all that stuff over, it may not actually be as stressful as you think it is. So that prompted me to say, I told him flat out, I said, I don't know what that case is because I've taken my eye off the Fed's balance sheet and it's high time I put my eye back on it. So yesterday I spent about an hour putting together a chart to look at what's happening within the Fed's balance sheet. And because y'all know, who've been with me for a long time, you know that I have a massive spreadsheet breaking down the Fed's balance sheet, the H.4.1 report, from a variety of perspectives. Not all of that data and all of my observations on that have been good because it's hard to figure out what's going on with this stuff every once in a while. But what is always interesting is when the Fed starts adding new categories to their balance sheet statements. And they've done so over the last couple of months, breaking out, adding in both repo and then breaking down repo and the loans that they've now started to take onto their books as part of the CARES package. And so that's in there as well. So there's going to be, this chart's very interesting. It's got 3 categories on it. It's got the amount of repos that the Fed's carrying on its balance sheet as of right now, the amount of central bank currency swaps, U.S. dollar swaps, that are on the Fed is carrying on its balance sheet right now, and the amount of loans that are on the balance sheet. And those are the interesting things because those are the 3 things that have changed in the last year. Everything else, the Fed is buying a whole bunch of treasury bonds and monetizing them and handing them to the treasury to try and keep the economy from completely collapsing. Yeah, we know that. So there's QE and it's vertical. That's not the interesting part. If you dig into the H.4.1 report, you see exactly what I saw in this chart. So I'm going to paint the picture in charts in a little bit, but I just want you to understand this is what's going on. And then at the same time, we've got this weird, crazy breakout in the U.S. equity markets, right? While the euro is breaking out, while safe havens are flat, right? So gold is sitting here as a floor underneath the market, saying no, $1,700 on gold is the floor. For those of you who don't know what holds your floor up, they're called joists, right? The beams that run under your subdeck of your floor are called joists if you live in a 2-story house. FYI, that's where that word comes from. So turn that off. Okay, so forget to turn the phone off so that you guys don't hear my phone notifications in the background. Oh, look, email. So gold is sitting here flatlining. Bitcoin sitting here flatlining. The euro's breaking to $1.14. What's going on? Like, what's happening here? And it's a very weird trade because the strong dollar, strong gold, strong equity market trade was in place for a long time, right? Safe haven trade, simple. Get to hard assets. Bitcoin, gold, the US dollar, stocks, hard assets. And US treasuries, because hard assets, relatively speaking. In the modern definition of these manipulated markets, those are your 5 hard asset classes. Yeah, you could add German bonds and you could add Swiss franc bonds as well, and to a lesser extent even UK gilts, but let's, keep it simple. Now we're getting a break of that. Stocks are going crazy. Gold refuses to drop. Bitcoin is being capped at $9,700, $9,800, right? Capped below 10,000. Certainly capped below 9,800 on a weekly closing basis. That's really obvious at this point. Actually, they're now managing Bitcoin on the 15-minute chart. I was watching it yesterday. I was just like, I posted on the Slack server. I'm like, you got to be kidding me. Come on, guys. Like, all you're doing is, and I don't have enough time to do all the charts that I've been looking at, but let me tell you, what's the burbling underneath the crypto market in high quality altcoins, because they're capping Bitcoin, so we're starting to see money flow into all the other coins. You're seeing the currency pairs between those and Bitcoin. So BAT versus BTC, Dash versus BTC, Ethereum versus BTC. They're all rising. Right? They're all starting to break out to the upside because they won't let Bitcoin rise. So, and the Grayscale Bitcoin ETF is buying 150% on a weekly basis of the new issuance. So like people are, like Mike Shedlock are saying, Bitcoin's it's not a real store of value, blah, 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 blah. The halving didn't do anything. I'm like, dude, just wait. Like at some point the supply dries up and then everything goes ballistic. And the market is different in this happening than it was in the previous one because now we have futures trading, cash settled futures trading, which is a tail that wags the dog. And we all know that story on the gold market. So, all right. But Mike doesn't really buy any of those arguments as well at a fundamental level. So it's fine. We're allowed to disagree. But all that means is that these markets are coiling. They're like springs getting compressed. They're coiling. They're getting ready to strike higher, depending on what Powell does today. So it's going to be very interesting to see what he does. If he goes for negative interest rates, if he hints at them at all, we're going to see the dollar sell off. I agree with Rabobank, the analyst at Rabobank on this. If he doesn't do anything, we're going to see higher rates on the long end of the yield curve. If he goes for yield curve control, like the Bank of Japan, which is possible, I don't know what's going to happen there, right? It's going to be, it'll be bad for the dollar, depending on where he puts the control on the curve. He's not going to put control on the 10-year bond. He can't take away the most important market in the world. If he does that, forget it. Credibility of central banks will be destroyed. It will be considered a panic move. I think the best way to look at it will be considered a panic move by traders. We'll see probably a false move down in the dollar, and then an explosion to the upside as everybody starts trying to figure out what in the hell to do next. Okay, if you put upward control on the if you cap the 10-year bond at that point, you create one-way trades everywhere. And dogs and cats living together, mass hysteria. So let's get to the charts and I'll get you out of here. Okay, so gold, like I said, refuses to back down. On Friday, on Sunday we were talking about this, going, hey, we have a consolidation period, consolidation trade going on here, 8 weeks now, or 4, 5, 6, 7, 8, 9. Now the ninth week. And I told you, watch for 1661.39 on the low end. Watch the bottom of this range, and then watch this top, which is around 1752 or so, 1753. This is your current trading range in gold. Anything inside of that is noise. Period. It's noise, and it's going to move to the extremes in that range until it decides to break out to the upside. What we're looking for here, technically speaking, we could see that this is a big, long, sloppy uptrend, and this is a 3-bar reversal to the downside. And now we have an inside bar after this weak reversal bar, right? This is a weak reversal bar. It took 3 bars to close below the low of this bar. And this uptrend, this reversal signal here, was never reversed by any of these down bars. So therefore, this uptrend is effectively still in place until we get to here. Then we get 2 in a row, then we get 3, and we get a weak reversal signal within the context of this consolidation pattern. This is very bullish behavior on gold's part. And then we get it, and now this week we can't break either the previous high nor the previous low, even though we had a coin flip to the downside. We had a really good shot, a good solid shot of breaking the low to the downside. We didn't even approach it. And what happens if we get a rally here to the upside? That would be major, considering that we had a 4% chance of it happening. So, gold will be interesting for the next couple of days. I don't believe that it's going to explode to the upside. But again, we have the Fed. Major meeting here with the Fed and an 8-week consolidation pattern. Okay, so that's what's happening in gold. Now we move to Bitcoin. Sloppy, but yet the same kind of thing happening here. There's a definite cap on the market. All these high tails here point to them trying to cap the weekly close below around the 9,800 level, the 9,700 level. And that's where we're trading at right now. And today we're trading about, as I went to press this morning, about 97.70. And that, honestly, we've been trading there within $100 on Bitcoin for 2 days now. Sunday we were trading at 94. It popped up to 97, and it's kind of flatlined. Go look at a 15 or 30-minute chart. It's just been flatlined. There's moments where it tries to break out and then gets slammed right back down again. Moments where it tries to break out above 9,800, slammed right back down again. Someone's accumulating at that level. Because if they weren't accumulating at that level, these lows wouldn't continue to get higher. Someone keeps pushing up, and the bulls keep saying, no, we want to go above 10 grand. And the bears keep saying, no. And that's what's going on. Bears are going to lose here. Especially if Powell... What if Powell goes to negative interest rates today? You think Bitcoin's going to hold below 10 grand? You think gold's going to hold below 1720? No, the market's going to go ballistic to the upside. Goldman's talking about gold going to 2,000 now. All right. So there we are. And so far this week on Bitcoin, same as gold. Inside bar. There's last week's bar. Didn't break the previous low. Haven't broken the previous high. We got a long way to go to 10.302. I don't know that it's going to happen. I don't even care if it doesn't happen. At this point, I'll take a daily close above 9,800. Just to prove that Bitcoin's got, that the bears are being broken down. That's what it will take at this point. But still want a weekly closing settlement above 10.5. That's the trigger here. This high, and then we go back to this one here, 10.301, then 10.482, and then whatever this one is. I don't know what this one is. Probably about 10.6, 10.7. These are your definitive areas. But any kind of weekly closing bar above 10,000 on Bitcoin would be a huge thing, considering how much resistance there has been to a weekly closing price above 10,000. They're so desperate to keep that from happening. They do not want to see a weekly closing price above Bitcoin, above 10,000 on Bitcoin, because then they have to write about it. If it's at 9,800, no one cares. 10,000, all of a sudden, editors have to write about a $10,000 Bitcoin. Peaking above 10,000 and not being able to hold it, no one cares. Brent. Told you that Brent, we talked about this on Sunday, that Brent, once it broke above that. And once it closed above 36.40 in May, it was going to try and fill this gap because this gap needs to be filled. Markets hate gaps. Well, we've mostly filled that gap. We got to go all the way to 45.20 to fill that gap on Brent. And we haven't actually reached that number. The high here is around 43.80 or so, something like that. But yesterday, Zero Hedge ran a thing. Hey, oil closed down on a surprise inventory build at Cushing. Really? Are you that surprised? Really? Come on. Really? All right. Like, at this point, don't believe any of it. And oil price even had to run an article, or I get their weekly newsletter blurb in my inbox, and their spam in my inbox, and their newsletter this week is, why did oil not break out after the new OPEC Plus extension? Because the OPEC Plus extension is nothing compared to the demand destruction within the oil markets. We're not ready yet for a price inflation in commodities, I think, based on supply contraction. I think that's going to take another 3 to 6 months. And then we're going to start to see a real bull market in things like oil, copper, nickel, and other things, where once we fully understand just how much demand destruction there's been and we bleed off the excess supply, then we're going to start to see that. We're already starting to see it in food prices. So the latest consumer price index stuff came out, and yeah, food prices are up 10% year over year. Meat up 10% year over year. So it's coming. The commodity inflation is coming, and that's going to be stagflation. It's going to be demand destruction, and it's going to be supply destruction along with demand destruction. It's going to be supply push, not demand pull. And Trump's going to tweet demand pull. The markets are going to be saying supply push. Okay? But we're not right there. We're not there yet. So now the dollar. So all this is happening, and the euro is breaking to $1.14, and we got back-to-back reversals here on the weekly chart in the USDX. Even the U.S. trade-weighted dollar index is broken down. Finally. And we're down here. Okay. Is the U.S. dollar about to collapse? Well, or are we unleashing the loss of control in central banks? Does anybody believe that the U.S. dollar is going to collapse on the Fed losing control of the dollar, of dollar markets? Really? Like, anybody believes that? Like, there's still the structural bull case. I mean, like I said, the article of Rabobank from Zero Hedge this morning is really good. He acknowledges the structural argument for a strong dollar is right here. The Fed is doing everything imaginable to stop that from happening. The ECB is trying to stop that from happening. But the ECB can't afford to have the euro break to $1.20. You know what happens at that point? Italy's balance sheet implodes. No amount of stimulus or QE from Lagarde's going to stop that. I mean, the euro at $1.20 is going to cause the Italian government to fail. And they're already pissed off. They're already beginning to believe that COVID-19 was nothing but a cover story for them. Everybody's angry at the EU at this point. So they're playing with fire here at $1.14, no less $1.20. They're all going forward with contact tracing and all the rest of it. They're going to kill what's left of the tourists. And Martin Armstrong this morning just put it bluntly. They go forward with contact tracing. Forget tourism in Europe. That's 10 to 15% of their GDP wiped off the board. Because who the hell is going to go there? Who the hell wants to do that? And again, I've been saying this from the beginning. The EU is the new California. They want to be able to export their stupid rules and regulations to the rest of the world by forcing everybody to standardize to them. It's the fundamental fight of Brexit. It's why they're tearing down statues in UK to stop this from happening. They're going to get everybody on the wrong side of this trade. I agree with Martin here. They're going to get everybody on the wrong side of this trade. And then it's going to explode in the opposite direction. And here's why. Okay, so this is a complicated chart. I tried to do my best to work through the timeline here. The Fed is trapped. We know this. We've known this for years. The repo, we're getting rising repo stress again. But let's go and talk about all of it. I sent the chart all the way back to when the repo crisis started back in September of last year, and we saw the Fed come in and opened up the repo windows when SOFR seized up. They came in, they provided liquidity, and that liquidity and the need. This is the amount of of repos that the Fed is holding on its balance sheet as of Wednesday night each week, right? And so that number was rising all the way through the end of the year, right? And that's when they announced that huge repo, huge repo facility which nobody used. They announced a lot more repo capacity than people used. That was in order to try and get everybody to think, oh, everything's not so bad. We come into the new year, people are repositioning differently, yada yada yada. The worries start to go away. There's a little bit of central bank, foreign central bank swap activity, not enough to care, a couple $1 billion. And then boom, 2 weeks before the corona apocalypse happens, before the market spasm, repo starts going crazy to the upside. Banks start going into the repo markets to get dollar liquidity, get dollars. Oh my God. And that's when we reach the peak. That's when the market spasm, COVID-19, all 9 yards. But this is before Putin says no, COVID-19 and all of this. This is all happening 2 weeks beforehand. Once this starts, then the Fed has to start creating swaps with foreign central banks to provide them dollars. $450 billion, 2 months later, $450 billion worth of that. Similar to the amount of money that they ever had on their balance sheet in the repo markets. And then the spasm ended, the repo stress collapsed down to here. These are the loans that come out after the CARES Act, and they peak, and these are all the small business, supposedly the small business loans and the rest of it, and they're holding $100 billion on their balance sheet, whatever. This is actually the only good thing the Fed's done, right? The rest of this is all fueling what's happening in Seattle and what's happening in Minneapolis. This is the problem. But the central banks are still buying. And week to week, the dollar's in the tank. Supposedly, the dollar's in the tank. The dollar's shed 4%. Why are central banks still having to swap to get dollars from the Fed? Somebody riddle me this, Batman. And now, 2 weeks ago, repos started to rise again. And look at the rate of ascent. It's pretty strong. It's half the rate of ascent that it was in March. I'm not saying that the next spasm is going to be equivalent to the one we had in March, but it's going to be big. U.S. yield curve looks beautiful at this point, and now into this mess, Jerome Powell is going to speak this afternoon. Anybody have any idea what he's going to say? I don't want to be him. That's a thankless job. That's like being a New York City cop at this point. And then we have the Dow. All this money sloshing around, doesn't know where to go. Retail, and this is a retail-led rally. You think the banks who have been getting bailed out here and the people, you think they're gonna algorithmically hold down and trade against this crap? No, they're gonna hold and let retail run wild buying stocks at this point. They'll smash them down at higher levels and make more money. That's what they'll do. And that's exactly what's happening here. NASDAQ's at all-time highs. People are buying Tesla, and now they're buying this, I don't know, what is this, the Nikola, the new truck, which is, that company's now worth more than Ford. I mean, not that Ford's a well-run company and Jim Hackett should be sacked like last year. But come on, man. And wait until oil's $125 a barrel again, and that guy's going to only make trucks and SUVs? Like 3 years from now, I know my wish of the current new Ford Focus will be in the United States, because Jim Hackett will no longer be will no longer be running the company, and that thing will be the most popular car in the United States. Because Ford will be selling them for like, $12 for Christ's sake, and oil and gasoline will be back to $4 a gallon. All right. I can only hope. Sorry, I really love my Focus. It's a freaking great car. I can't believe it. I cannot believe that. I can't believe that guy. What a fucking shit lib. Oh my God. Sorry for that. Unbelievable. What a tragedy the United States has become. Unbelievable. Unreal. All right. So don't believe that this is going to, the current trend is going to continue. We're going to get the apotheosis of this V-shaped recovery. And then it's going to reverse on us, and it's going to reverse hard. And I think the guts of the market are telling us that. The Fed's balance sheet is telling us that. So watch it carefully. It doesn't hurt that all of Martin Armstrong's arrays are pointing at, like, middle of June. Something bad is going to happen across all these markets. Something's going to change. If you want my honest opinion, this and this together tell you that the central banks are still under stress, and now the domestic banks are under stress. Now what do we do? Everybody still needs dollars. Yeah, the rate of their buying is still here, but now this is the floor. What if this is the floor, and they need another $400 billion in 3 weeks? That's what I'm trying to say. Ponder it. Think about it. Get back to me. Leave comments. Tell me to stop using my potty mouth. We'll talk Sunday. You guys be well. Be good. Keep your stick on the ice.